Hi, welcome to this video, which is all about Forex money management for beginners and how to place stop losses correctly. Now, in terms of most beginners, they will make errors in terms of the way that they place their stops. And in terms of these errors, I've got a list of them. If you make any of these errors, your chances of winning Forex trading are not good at all. You'll probably end up in the majority of losers. Now, in terms of the stop loss errors, I just want to go through them and why you need to avoid them. Once you see the logic of why you need to avoid the errors, then you will do so. Now, a lot of traders just don't think enough about stop loss placement when they come in the markets. They're too focused on their entry, but your stop is as important. In my view, it's probably more important than your entry. Right, in terms of looking at the stop loss errors and why you need to avoid them, we will just go to a storyboard and review them all in more detail. All right, let's have a look at some common Forex stop loss mistakes and some tips for profit. Now, in terms of point number one, risking too much per trade. I'm sure anyone watching this video will not be surprised to hear me say that is a common beginner's mistake. It is, okay? However, another mistake is too much exposure. And it's not to do just with the risk per trade. It's all about exposure. I'll explain this in more detail. A lot of traders, let's say, for example, will read online that 2% per trade is, risk per trade is the optimum amount to risk. 2% on trade is fine, okay? But it depends on how many trades you've got on. A lot of traders think that, I could risk 2% per trade, and they do 10 trades. Well, that's giving you an exposure risk of 20% if everything goes wrong. A lot of traders say, well, I've diversified across a number of different pairs, so that makes it safer. No, it doesn't. If one pair can go wrong, so can 10. You keep an eye on overall account risk, exposure, not the risk per trade, okay? Now, in terms of risk per trade and account exposure, this is the way I see it. Maximum risk should be, in my view, 5%. Now, that 5% can be made up of one trade at 5% or two trades at 2.5%. It doesn't matter. It's the account risk exposure in the market overall that matters, okay? 5% is a good amount to risk overall on your account, in my view. Okay, once you get above 10%, risk to ruin in terms of probability increases dramatically. If you've got a soundly based strategy, you've researched 5% total risk, in my view, is okay. All right. Now, in terms of point number two, using mental stops, a lot of traders do this. They say, well, in the market now, I'll get out at X level if it gets back to the level. Trade comes back towards their stop, hits it. What do? Basically move it back. The reason they did a mental stop is they didn't really want to take the loss in the first place. You should just put the stop in. Okay, if you decide that's your get out point, you put the stop in, you adhere to it. Once you use a mental stop, it's hit, you just keep moving it back and back because your emotions are involved. Okay, so stop in the market. Once you've got your stop in the market, never move it back. A lot of beginners make this mistake as well. Prices come near their stop, then start to firm a little bit above the level, and they think, well, I'll just move it a little bit further back just to be safe. It's a huge mistake, because if you move it back once, you're probably going to move it back again. You've decided the get out place. Then you get out, and you can always get back in, So your mental stops and moving stops back, huge error. Another big error is determining the trade size. Then that determines the stop distance. You do not determine the trade size first. Because if you do, let's say you've got a big trade size, you've decided to risk 2% on the trade, you might be putting your stop too close. You do it the other way round. You decide, first of all, you need to decide your risk per trade. Let's say it's 2%. Then what you need to do is do the stop distance from your entry. Okay, so let me give you an example. If the stop distance is 100 pips, okay, your trade size would be double than if the stop distance was 200 pips. Okay, so it's risk per trade, then the distance to stop, and then that will determine the trade size. Because obviously some trades will need wider stops. If you've got a wider stop, 200 pips, then that trade size will be half of one that is 100 pips. That is the way that professional traders determine trade size. Okay, they do not determine it first and then just put the stop in at a fixed percentage, which a lot of beginners do, and it's a massive error. Point number 4 is one of the dumbest mistakes in Forex, in my view. You can really tell, someone is going to lose when they keep moving their stop to entry to prevent loss. So the trade goes in their favour, they immediately jack the stop up to entry, and their logic is, well, I can't lose anything now, it's a free trade. No, it's not, because if you've got a strategy you're confident in, you don't move your stop to entry too quickly. You'll just get caught up in the noise, get taken out by a small retracement, then the trade could run on a good distance the way you thought it would, and you're not in the trade. So moving stop to entry is a real, it's just basically an error which beginners don't think about. It's where their emotions get involved. They just want to prevent a loss above all else. They don't think that they're actually losing perhaps a really big profit opportunity. Anyone who's confident in their trading strategy and the trade they've got does not move their stop to break even for the sake of preventing a loss. Another dumb mistake, in my view, is hedging a losing trade with a counter trade. So you do a trade in the opposite direction. And you see a lot of people talking about hedging strategies online. You hedge in the loss, and then you basically take the hedge off at the right time, and then you can get back to profit. What's the difference between hedging a loss in the market rather than using a stop loss? If you use a stop loss, you've basically guaranteed how much you're going to lose. If you put a hedge on, you've guaranteed how much you're going to lose. Okay, you've locked in a loss. Okay, a lot of people hedge because they don't want to take the loss. You still got to take the hedge off. It's a totally dumb mistake, in my view. Point number 6, stop behind obvious level on the chart. Beginners make this mistake all the time. They look at the chart, they see a level of, let's say, support where they're long. It's a level not too far away from their entry, and it's an obvious level. If it's an obvious level, it's obvious to you, it's obvious to everyone else, it's obvious to professional traders, big funds, etc., who want to catch retail trader stops. They'll just push the price towards the obvious level, collect the stops, then the price will go back the other way. You do not want your stop behind an obvious level. You look for the obvious level and go one level back. Okay. Placing stops on or near round numbers. Round numbers are very important in Forex trading. And you find many traders want to place orders or stops on round numbers. No. Institutions know that, and there's always huge order flow around round numbers. So basically go back from the round number. If I've got a round number, I want to put a stop around the level, I'll put it 30 pips back behind the round number, so that if institutions, stop hunters push price towards the round number, they hopefully won't catch my stop. It's normally 30 pips away, sometimes a little bit less, but never on a round number or within a few pips. Point number 8, stop static and not exiting when in doubt. A lot of traders put on trades and they basically put the trade on, put the stop in, put the target in, then they just wait. Either the target's hit or their stop's hit. Well, Forex trading is very dynamic. If the trade starts coming back, the market isn't behaving the way that you thought, you're in a little bit of a loss, your stop's, it's a little bit further back, you've got a loss, you'll take a bigger loss if your stop is hit. Deep down, the price action isn't doing what you think it should. Just exit with a smaller loss. A lot of traders won't do that. You've got to be kind of dynamic, in my view. So yeah, there's 8 common mistakes. And obviously the tips for profit come from avoiding the mistakes. So yeah, in my view, all those mistakes very, very easy to avoid. You can see the logic of why you should avoid them. So that is the video for today. Hope you found it informative. Thank you very much for watching me. Take care. Have a good day.